All right, everybody, we're going to go ahead and get started here. My name is Darren Wagner. I'm the founder of Morpheus Trading Group, which we founded back in 2002. Joining me this evening, we have Rick Petticelli. Rick is my right-hand man. He's been with me for, over 15 years now. He's also the editor of the Wagner Daily newsletter, and he's the one that seeks out many of these fine stock picks that you see every day in the newsletter. So thank you for joining us this evening. We are recording this evening's session, so don't worry if you can't jot down notes fast enough. You'll be able to review this on our YouTube feed and our Facebook feed after the session. If you have any questions as we proceed, feel free to just jot your questions down in the comments there, and we will get to your questions after the presentation. We're going to go about 45 minutes or so with reviewing the topic, which is how to manage your winning trades, and then we'll have some time for some questions at the end. So without further ado, let's dive in. You're here tonight to find out how to properly manage your winning trades. And although that may sound like a simple topic, it's not. The funny thing is, there's lots of books about trading and there's lots of websites about trading. Most of them talk about when to buy and give lots of tips on technical analysis of when to buy and how to know when to buy and which stocks to buy. But very few books and very few websites talk about when it's time to sell and the proper time to sell. And that's why we feel it's a topic that is not covered enough. And it's a topic that's really important when we're in a raging bull market like we've had been, so that you can make sure you maximize your profits when the inevitable market correction comes and stocks start to pull back. It's important to be able to maximize your profits. Of course, the goal with selling your stocks is to sell at a time that's not too early, where you're leaving a lot of profit on the table. But at the same time, if you get too greedy and hang in there too long, the stocks reverse and you give back a lot of your profit. So what we're going to show you tonight is a really simple way and a simple indicator to help you understand when to sell most of the time at the right time. And I say most of the time because if I would say, yeah, this indicator is going to work for you 100% of the time to sell at exactly the right time, well, I'd be full of it, right? And anyone that tells you that doesn't know either. But I will say that this is one of our most reliable, tried and true methods in the almost 20 years that we've been doing our trading methodology. It works very well for us, and it's the basis for how we know when to sell stocks in the Wagner Daily newsletter. So again, if you're just joining us, welcome. No need to take notes. We are recording this session. Okay, so you should be looking at a chart right now of DDog, TDOC. And what we're going to look at tonight is actually 4 different charts, and we're going to analyze those charts. Of those 4 charts, 3 of those charts are stocks that we're currently in the Wagner Daily newsletter. We're already long, and we can talk about how we're going to know where to sell them. And one of those stocks is one that we've already sold, but it's still good for educational purposes to look at why we sold it, where we sold it, when we sold it, etc. So before we dive into the individual stocks, let's talk about really what the main indicator is about. It's all about moving averages. As you can see on the chart here, it's all about moving averages. Yes, moving averages are one of the most simple technical indicators at your disposal. However, it's also one of the most reliable and most powerful indicators. Those of you who've been with Morpheus Trading for a while know that we believe in the KISS methodology. Keep it simple, stupid. There's many technical indicators out there. You've got Bollinger Bands, you've got stochastics, you've got MACD, you've got all types of indicators. And the thing is, if you try to use all those indicators, you're going to get confused and you end up spending all your time analyzing stocks rather than actually making good trades. So we're of the big belief that the best trading systems are the most simple trading systems. And in that regard, one of the most reliable and simple indicators we use for knowing when to sell is indeed moving averages. Now, as I'm going to get into here and explain to you, the actual moving average that we use depends on the stock's price action and what type of trader you are. But let's first of all review the types of moving averages that we use on our charts, and we recommend you set your charts up the same way. You see here on this chart of DDog, we've labeled the 10-day moving average, which is this line right here. We've labeled the 20-day exponential moving average, EMA, which is this beige line. And by the way, there's not a big difference between the simple moving average and the exponential moving average. Whatever you use is okay. Just make sure it's consistent and use the same one every time. But we found that the 20-day EMA gives us a little bit earlier indicator by using the exponential moving average. So we like to use the EMA. For the other moving averages, we use the simple moving average. So again, it's a 10-day moving average, the 20-day exponential moving average, this beige line, the 50-day moving average, and the 200-day moving average. Now, the reason moving averages are so incredibly powerful is because they show you the direction of the trend. And we're trend traders. We only want to trade in the same direction as the trend. However, the trend can be different depending on the time frame you're looking at. When we had our webinar 2 weeks ago, we talked about the importance of looking at multiple time frames of charts, looking at hourly charts, daily charts, weekly charts, even monthly charts. So the moving average that you're looking at depends on the time frame of the chart you're looking at and also the type of trader you are. For example, if you're a position trader, someone who likes to hold positions several months at a time through a dominant trend, then the 50-day moving average is going to be very important to you. In fact, the 50-day moving average is typically known as the level where institutions like mutual funds and hedge funds and other institutions will step in to buy an uptrending stock when it pulls back and touches the 50-day moving average. If you're a really long-term investor, then the 200-day moving average would show you the trend. Any stock below the 200-day moving average is in a long-term downtrend, generally speaking, and above the 200-day moving average is in a long-term uptrend. But what we're mostly going to concern ourselves with in tonight's presentation is the 10-day moving average and the 20-day exponential moving average, the 20-day EMA for short and 10-day MA, because these are the time frames that matter the most for the time frame of trading that we do. We're what we call intermediate to long-term swing traders, which means that sometimes we hold a stock for only a couple days to a week, but most of the time we're holding stocks several weeks at a time, all the way up to several months, depending on the price action of the stock. So again, we're focusing our attention here on the 10-day moving average and the 20-day moving average. So in a nutshell, what we're looking for in a strongly trending stock is we're looking for a breakdown below the 10-day moving average or a breakdown below the 20-day EMA on stocks that are extended to the upside. So in general, if a stock is obeying the 10-day moving average as it's rallying, meaning that every time it's rallying, it's holding above that 10-day moving average, then when we get to about 15 to 20% beyond where we bought it, then when we break below that 10-day moving average, that's a sell signal. Let me repeat that again. If a stock is following the 10-day moving average as it's trending higher, like this stock has, notice it dipped only 1 day below the 10-day moving average, and then it went higher. If it's following that, then once you've got a 15 to 20% gain beyond your breakout entry, then you're going to use a breakdown below that moving average as a sell point. But when it breaks down earlier, like for example here on this breakout, we had 1 day breakdown below, we don't sell at that point because it's too early in the trend. And notice that's just a shakeout, and we went right back up above it the next day. But now if the stock continues to move higher for the next several weeks or however long it takes, then on a closing basis, I should say, not on an intraday basis, on a closing basis, then we would look to sell. Now that can also be the same case with the 20-day exponential moving average. So for example, perhaps a stock is not in as strong of an uptrend. It's in an uptrend, but not as parabolic, not as straight up in the air. And let's say it's dipping below the 10-day moving average, but it's holding above the 20-day moving average. Then that 20-day EMA becomes the point. And then again, same thing. If you buy and the stock goes up 15 to 20% as a rule of thumb, and it's holding that 20-day EMA on a closing basis, when it breaks down below that 20-day EMA, that is the sell signal. So that's in a nutshell the magic indicator. It's a really quick rule of thumb to use, but there's a lot of other details that go with it and secondary signals that we use for determining when to exit. Generally speaking, we give winners some time to work. You never want to cut your winners too short, because if you cut your winners short and you cut your losses short, you just spin your wheels and never make any money. The idea, of course, in profitable trading is to cut your winners short, cut your losers short, but let your winners run. So we always want to give winners some time to work. And by using the 10-day moving average or the 20-day moving average as a guideline, as a base guideline, that gives you the wiggle room that you need for stocks to oscillate while still maintaining their uptrend. So, for example, when we risk when our risk is equal to when our profit is equal to 1 times the amount of our risk. So let's say, for example, we're risking 1 point on a trade. Let's say we bought this trade at 94 and our stop is 93. Not a good example, I guess, because, well, in this case, if we bought it at 93, let's say our stop is 87. Okay, so in that case, we have a, if we've got a 6-point stop, that means when we're up 6 points, our risk is now 1 to 1. Our profit is the same as what we're risking. But we don't look to raise the stop at that point because we've not made enough profit on this stock. We'll still maintain our original stop. However, when the stock moves up higher and now our profit is 2 times our initial risk. So if we're risking 6 points on the entry and we're now showing a 12-point profit, now at 2 times our initial risk, when our profit is 2 times our initial risk, now is the time to look at the chart and figure out where our stops should be and where to adjust our stops. Again, using the 10 or 20-day EMA to manage the position, as we talked about earlier. Again, stock breaks out. If it holds a 10-day EMA, that becomes your baseline. If the 20-day EMA is the signal that it holds, then that becomes your baseline. And when you're up 15 to 20%, a breakdown below that, as long as you're up at least 2 times your initial risk, is where you look to sell. Now, if you want a position trade, you want to hold your positions a bit longer, hold your stocks a bit longer if they're winning, you can scale out of your position. And we do that a lot in our newsletter, the Wagner Daily. If we have a winning trade, in fact, we recently did this with Shop, which I'll review in a bit here. We actually sold this winning trade in 3 different increments. For example, we sold part of it on a break of the 10-day moving average, more on a break of the 20-day moving average, and then sometimes you can hold the rest for a break of the 50-day moving average, depending on your time frame. So there's nothing wrong with scaling out of a trade as well to maximize your profits, especially if you're not sure about the sell point. So that's the general concept. Now let's look at some actual charts. Let's look at 4 charts to kind of piece that all together, what we were talking about, how to apply it. So with DDog, let's look at the trade setup here. We actually bought DDog back on January 7th, which is right here. Okay. We bought DDog this day. Oh, didn't want that. We actually bought DDog on this day right here, the 7th. Notice how we had the previous day on the 6th. We bought the stock because we had a big move up above the highs of the consolidation. And then we had a slight pullback the next day. So that gave us a low risk entry point to buy DDog. So we bought it at 85.70 is where we're actually long. In the Wagner Daily newsletter, we're long from 85.70, which is right here. That's where we got in it, right there. And we sold half of the position already on January 23rd. So let's go to January 23rd, find that. That is this day right here. Let's go ahead and mark that with an arrow again. So 23rd being right here. Oh. Not my annotation tools are not cooperating. $23rd, right here. Okay. So this is the day we sold it. So again, we bought it on the pullback. We had the big gap up 4 days after we bought it. We don't sell there because that only gives us a profit that's equal to 1 time our initial risk, right? We're looking for at least 2 times our initial risk or a 15 to 20% gain. So when we had this move here, in this case, notice this, in this particular case, we did not sell on a break. We did not sell on a break of the moving average because we were actually looking to sell a partial position into strength to lock in gains on part of the shares because we had a nice gain after 3 days up in a row. Volume was not picking up. We had decreasing volume. We didn't like that because the lack of increasing volume tells us that there's not really institutional support driving the stock higher. So we made a judgment call on the 23rd to sell part of our position. And that's what we did right here. So we sold 30% of our position, basically almost a third of the position at 100.95, which is right basically near the lows of that day. All right, so that gave us an 18% gain from this entry here to this exit here. We had an 18% share price gain. Again, just locking some gains on the move up because we didn't like the volume necessarily, so just selling into strength. However, the important point is we held 70% of the position until it actually gave us a valid reason to sell. So we actually sold a couple days later, we sold another partial position on the 27th, which is right here. Do another arrow. 27th right here, we sold another partial position. And the reason we did that is you can see what happened here. We had the day after we sold our first 30% to lock in an 18% gain, we had a big down day, bearish engulfing candlestick, and next day we gapped down below the 10-day moving average. Now again, in this case, the 10-day moving average was where we were holding above as we were rallying, right? We said 15 to 20% above the entry. It held above that 10-day moving average the whole way up. So a break below that moving average is our signal to sell. And that's what we did. We sold 20% of the position at 94.86, which is basically right near the middle of this day's range. That gave us a 10% gain on the second share. So again, we got an 18% gain selling here on 30% of the position, 10% gain selling 20% of the position. So that gives us almost, let's see, what is that? About a 13% average gain so far on 50% of the position, on half of the position, about a 15% or 13% average gain on half the position. Now we're still holding on to the remaining half of the position. Now, why are we still holding on to the remaining half of the position? Well, because we went down below that 10-day moving average one day, popped back above it, and notice now it's again on a closing basis been holding above the 10-day moving average. We haven't had a close below the 10-day moving average since that one day where we sold part of the position. So guess where our stop is now on the remaining shares? If you guess below the 10-day moving average, you're right. Because now if we go back down, again, on a closing basis, if we go back down on a closing basis below this 10-day moving average, it's the second time below. That's another sell signal for us. But now we're maximizing our profits. We're going to sit in this and ride the stock higher as long as we can, as long as it holds above this 10-day moving average. Whenever you try to predict where a stock is going to stop rallying, you're probably going to be wrong most of the time. I know we are. It's impossible to predict how much momentum a stock is going to get. So we don't try to predict. What we do is we react to price action rather than predicting price action. So if we're not predicting price action and we're reacting to price action, all we need to do to make it simple is look for a breakdown below of this 10-day moving average on a closing basis, because that's the level it held on the way up. Now currently, we're already up about 20% now on this second half of the position that we held from our initial entry back here. It's already a 20% gain, and with the 10-day moving average still rising up. So even if it comes back down now in the next couple of days and closes below that 10-day moving average, because the 10-day moving average is rising, we've still locked in a gain probably equal to or greater than the gain we made on our first part of the position. But if the stock happens to take off and it rallies another 20% by chance, holding above the 10-day MA, then we might look to sell some into strength. But again, there's no reason to sell right now. The stock has not given us a valid reason to sell. So with DDog, we're willing to hold half of the remaining position since the price was emerging from a long base of support. And, you know, you can see that base. If we scroll in here, you can see that's the big base of support. So it's got more room to work. Because notice how this 50-day moving average came up right before the stock started moving higher. The 50-day MA held support. So that's our intermediate term uptrend line holding at support. Okay, so now let's look at SE, next stock, SE. We recently wrote about this stock actually on our blog when we announced tonight's boot camp session for how to manage your winning trades. And again, welcome if you're just joining us. Thank you. We're recording this session, so don't worry about taking notes. We'll put the whole thing on our website and on YouTube. And if you have any questions, just ask them in the comments there, and Rick will help you out. Okay, so let's look at SE. We bought SE way back in December 6th. We bought SE. So let's go ahead and drop an arrow so we can see our entry point at December 6th, which is right here. This was our entry. Oh, there I go again. This was our entry right here this day on December 6th. Now, we bought this because the stock popped above on an intraday basis, popped above the range. It didn't hold that day. It actually formed a bearish candle and came back down. So our entry was, you know, not in the money as soon as we got in, but we stuck with it because notice how it perfectly held the 20-day moving average. You see this? The beige line is the 20-day moving average. Notice how perfectly, since we got in, that 20-day moving average has been holding support. one time here, 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 and now it's started to move higher. Now the 10-day moving average has become support. Do you see that? When the stock was had this first gap up, the 20-day moving average held up, and now that's starting to get more momentum on the upside. Now the 10-day moving average is holding as support. But again, going back to our initial entry, even though the stock did not move into the money for us right away, it never gave us a reason to sell on because our stop was below the 20-day moving average, and it never went below that on a closing basis. So we just continued to be patient and hold the stock. And the patience is paying off. It took a while, it took a few weeks to get moving, but the patience is paying off now. We're still holding the full position because the price remains above the 20-day EMA, and it just only recently extended above it. It's not even that far above it. It's also now holding above the 10-day moving average. Furthermore, we have earnings coming up on February 25th. So because earnings is coming up February 25th, we'll likely raise the stop on half of the position just below the 44 level. Notice the 44 level now is where the 20-day EMA is. So as we approach earnings, we're going to trail our stop higher to below this 20-day EMA to lock in profits. So even if we get stopped out at 43.50, for example, we still have a nice profit from our entry way back here at 38.46, right? So that gives us a big profit regardless. And if the stock continues to move higher, if it starts to hold the 10-day moving average as it's rising up, we'll trail our stop higher in part of the position to even below the 10-day moving average to maximize profits. We have to be careful here because we did have a distribution day today. Notice the higher volume, increasing volume, and gapped up above the previous day's highs and closed below the previous day's low. This is called a bearish engulfing candlestick right here. So you don't want to see that. But there again, we don't want to predict price action. We react to it. So even though we don't like the action we saw today, it's still holding above the 20-day moving average, and it's still holding above the 10-day moving average. So, I think it's really important to remove the emotion from your trades by having an objective system for knowing when to sell your winning trades. And that's what these moving averages do. By having a system where you follow the trend of the 10-day moving average and the 20-day moving average and look for gains of 15 to 20% beyond your entry point, it removes the emotion and the feeling from trying to decide when to sell based on the day-to-day fluctuations and oscillations in the market. But you take the guesswork out of it and you make it objective. And that's really what we're trying to do here. And that's what you need to do to have a successful trading system over the long term, is make it objective and remove all the guesswork. All right, let's look at the next stock, which is YNDX. YNDX. Okay. YNDX is YNDX. That's a search engine, Russian search engine. Okay. And let's look at this setup. We bought YNDX way back in December 17th. So again, let's go ahead and mark our entry point. December 17th, right here was our entry. Now, why did we buy this day? Well, if you look back, we actually had kind of a cup with handle kind of formation going back before that. And then we rallied up above the prior highs, and then we waited for a pullback. We had a 2-day pullback to the prior lows, which acted as support, and that gave us a very low risk buy entry here, buying this at 42.51. So we actually were long right around this price right here, 42.51. And again, on December 17th. So again, we bought it on a pullback following a strong gap up. Notice the high volume gap up here, and then we had a pullback. So a 2 to 3 day pullback after a big gap up is a great entry. In fact, if you look at today's blog post, you'll see that we posted 2 software stocks that we bought in the Wagner Daily newsletter. Both of them rallied 6% yesterday. So if you miss those initial entries, you wait for a pullback, for example, 2 to 3 day pullback, as long as you hold the prior lows of the breakout day, that provides you with a low risk entry. And that's what we did here. So you don't ever even have to worry about buying breakouts, because in our newsletter, if we miss the breakout entry, we simply look for a pullback entry. Okay, so let's look at the price action since then. We're still holding the full position of this stock. Why are we still holding the full position? Well, there again, notice how perfectly it's held what? If you said the 20-day moving average, you're correct. The teal line has been perfectly, sorry, not the teal line, the beige line has been perfectly acting as support since it broke out. Ever since this big gap up day, the stock has not once gone below on a closing basis the 20-day EMA. This day right here, it closed right above it. Next day gapped up. Here we gapped down below the 20-day moving average, but closed above it. So on a closing basis, this stock has not one time closed below the 20-day moving average since the breakout way back in November. And that's a really good sign. And again, you're starting to see now how I was saying at the beginning of the webinar, beginning of boot camp, that it's not necessarily the 10-day moving average or the 20-day moving average. It depends on the individual stock, and it depends on the time frame you're trading as well. But you'll start to see trends, you know, when how a stock's acting, if it's obeying the 20-day moving average as support, or if it's obeying the 10-day MA, and then that becomes your line in the sand for your stop when you're trailing your stop. Now, YNDX actually had 2 days ago a big gap up, and you see this trend line we drew here? It actually gapped up above the upper channel of the uptrend. So this was the prior uptrend, upper channel resistance of the prior uptrend, and we gapped above that. So the biggest rule in technical analysis, the basic tenet, is that a prior level of resistance becomes the new level of support after the resistance is broken. So since we broke above resistance here, this resistance of the upper channel of the uptrend should now act as support on a pullback. And that's going to act as support as the 10-day and 20-day moving average catches up. What most likely is going to happen here, assuming the market stays strong, stays solid, is that this 10-day moving average is going to start to provide support because now we've got a stronger uptrend. So this 10-day moving average is going to start to act as support, most likely, just as the 20-day moving average acted as support before the stock started to move a lot higher. So we're going to keep an eye on both the 10 and 20-day moving average here as the stock moves higher, but we're still holding the full position because it's not really extended too far from the 20-day EMA. Only 2 days ago, we really gapped up above that range. So there's still a lot of upside room in this. And the nice thing is, because we got a low risk entry on the pullback, we can give it a lot of room to run. Just keep trailing our stops higher below the 10 and 20-day moving averages. All right, and the last stock that we want to look at here is called Shopify, a website you probably know, or maybe you use. And this was another great trade for us in terms of being able to scale out of it with the way that it works. So let's look at our entries and our exit points here. We bought Shop in the Wagner Daily newsletter. We bought it on December 11th. So let's go ahead and mark that again, December 11th, which is right here, December 11th. Okay, so you see our entry right here on December 11th was right here as we formed this bull flag pattern, and we started to move higher, close at the highs. We're long on from December 11th at a price of 374.26, which is right around the highs of this range, 374.26. After we got in, 2 days later, we had a big move up above the range. And since then, the stock's been in a steady uptrend. As you notice here, again, look how nicely it obeyed the 10-day moving average, which is this teal line. Here we had a test of the 10-day moving average, but we closed well above it. Here we closed right at it. Notice how on an intraday basis, we dipped below that 10-day moving average, but it closed right at it. Next day, we gapped down below, but again, closed right at it. We never had a convincing break. And keyword is convincing, because, you know, the institutions will try to run your stops to grab the stock cheap before it goes higher. So when I say convincing, that means a convincing break more than a few cents below on a closing basis below the moving average. We never had that. And then here again, we popped back up above the 10-day moving average. And after this move, notice how many days it went before it even touched the 10-day moving average. 3, 6, 9. Looks like about 15 days, about 3 weeks of trading firmly above the 10-day moving average. And then we had one gap down day on the 27th of January where we gapped down below that 10-day moving average. But look what held it. It perfectly, the lows of the day perfectly coincided with the 20-day exponential moving average. And we closed near the upper end of the range, the day's trading range, which is bullish. So what we want to see in a case like this, if a stock's been holding above a 10-day moving average, or a 20-day moving average for that matter, for several weeks, and then suddenly one day it gaps down below it, watch very carefully the next day. The next day, the stock should pop up back up to close above that moving average if the stock is still healthy, if the trend's still healthy. If it doesn't, then you got to watch out. But in this case, it did pop back above it, closed above the 10-day moving average, only spent 1 day below it, held it again. Look, notice here on February 3rd, dipped down below the 10-day moving average on an intraday basis, but again, we closed above it. You see how perfectly that acts, that 10-day moving average, how amazingly well that acts as a level of support on a breakout stock. And then the next day we gapped up higher. Today was again not such a good day. It gapped up above yesterday's high and closed below the low, formed a bearish engulfing candle on higher volume. So we did have some distribution today. But again, even though that happened, it still held the close above the 10-day moving average. Now, I'm just walking through the actual price action, what's happened. Now, let's look at where did we sell? Where did we actually sell in our newsletter? So let's take a look at this. On January 15th is where we sold 30% of the position. I mentioned earlier that we'd like to scale out of our positions, and we made a judgment call to sell 30% of it on the 15th of January, which is right here. Now, just like earlier, I told you that we sometimes will sell a stock into strength versus waiting for it to pull back. And that's what we did here. We had a nice entry. We had already a big gain. We had an 18% gain. Remember I said we look for a 15 to 20% gain from our entry point before we look to sell? And this was up 18% where we sold it. And we made a judgment call to sell it into strength rather than wait for the inevitable pullback and test of the 10-day moving average. So we just locked in a third of the profit, sold 30% of the position for an 18% gain here on the 15th, which is only 1 month later after we bought it for 18% gain. Then we sold another partial lot of the position on the 24th of January, which is right here. Except I put the arrow right over top of the price. Okay, let's see here. Let's try again. All right. Well, all right. Well, we'll keep it there. Anyway, this is the day that we sold on 35% of the position. On the 24th of January, we sold 35% of the position. Now, why did we do that? We did that because the stock moved a bit higher, consolidated, but then we didn't like this price action here where even though it held the 10-day moving average, it did dip down below the 2 prior days low. So again, another judgment call to lock in some partial profits because we already had, nearly a 20% gain at that point. So when we sold on the 24th, we actually sold at 459.81, and that gave us a 23% gain from our entry back here in December. So we sold again the first 30% of position with an 18% gain, sold the rest a few days later with a 23% gain, giving us an average gain of about 20% on the first 55% of the position. So now we've locked in a good, basically our target, 15 to 20%. That's our target for a lot of the trades we do, our breakout trades. We've already locked in the profit on half. And we did sell the remaining 35% of the position on the 27th of January, which was this day right here. So this day right here, when we gapped down, we actually did sell the remaining shares. Now, the thing is, if we look at this, the stock still held above the 20-day moving average. In fact, it was only 1 day below the 10-day EMA, as I talked about, and it held firmly above the 20-day EMA. However, we made a judgment call to lock in the rest of our position because the broad market was also not looking so good on that day, and shop started to stall. Shop had also rallied over 70% off its lows without so much of a rest. So when a stock's already rallied like 70% off its lows without taking a rest, you got to be, use a little bit of discretion there and play things a little bit more conservatively. So we did sell the rest of the position, the remaining 35% of the position, as soon as it broke below the 10-day MA on the 27th. We felt the chart was a bit extended with a 70% gain off the lows, and we felt it could pull in a lot more. So, we made about 20% on the first half of the position, 18% on the rest. So, 19% gain on the full position is okay. Now, this technically was not the best decision in hindsight. I mean, and I'm not afraid to say that because we're learning every day as traders. Even though we've been doing this, about 20 years already, perfecting our strategy, we still make mistakes, and we're learning every day. And in hindsight, it would not have been wrong at all. In fact, it would have been the correct decision to keep that remaining 35% because we only had a 1-day break of the 10-day moving average, and next day it popped back above it. What we could have done was kept it until it stayed closed maybe 2 days below there and then get out, or even wait for a break of the 20-day EMA if we wanted to. But again, we don't regret it because we still made a nice profit, and the stock is still struggling to go much higher here. It looks like it's going to take a rest just because of the massive rally off the bottom. So, rather than risking a big gain to try to get squeeze a few more percent out of it, we did sell. Although, we could definitely argue that that was a mistake to sell because of the price action was still pretty solid. So again, let's go recap. Those are the four stocks that I wanted to show you. Again, 3 of them we're still in. We're still in the DDog. We're still in SE, and we're still in YNDX, and Shop we're out of. But for those of you who are already Wagner Daily subscribers, now you have a bit of an idea into our peek into our brains as to what we're looking at for where we're looking to sell those and lock in profits on those positions. And more importantly, you now are armed with an awesomely simple and awesomely effective indicator for knowing when to sell. And that is, again, the 10 or 20-day moving average. Going back to our first chart, just to refresh your mind, make sure your charts always have the 10-day EMA, 20-day EMA, 50-day EMA, and 200-day EMA. For shorter time frames like we do with our trading, the 10-day EMA is a solid indicator, and so is the 20-day EMA. Remember, it depends on the individual stock. Some stocks will obey the 10-day EMA when they break out. Some will obey the 20. When you identify where the stock is finding support, that becomes your line in the sand, your sell point, okay? And if you're a position trader, you hold stocks a bit longer, the same principle applies even with the 50-day moving average, right? You can do this 50-day EMA as well. Because look here, going back, it dipped below the 50-day EMA one day, back above it. Here it tested it. It works the same way. It's just that the 50-day EMA is going to give you obviously much bigger moves up and down because it's a longer time frame that we're looking at. Let me tell you a few other tips here in addition to the moving average being the key point. Remember, we want to avoid analysis paralysis. We want to keep it simple, stupid, KISS. So moving averages really are the main thing that we rely on. And you want to follow whichever indicator the stock follows, and adjust for your trading time frame. But there are also some secondary exit signals that we can use as well to help confirm. I don't want to focus on these too much. We'll save that for another boot camp session. But a few other things we can use in addition to moving averages are distribution. We talked about that earlier, just in fact with this Shop that we just looked at. Let's go back to that chart. Shop had distribution today. Volume was higher than the previous day's volume, and we closed lower than the previous day's close. In fact, it was a bearish engulfing candlestick. So that tells us that institutions are selling. When you see distribution, it should wake you up. It shouldn't be in itself an indicator to sell, but it should definitely give you a warning sign to be alert and be prepared to sell in case we do break down below support of the 10-day or 20-day moving average. In fact, I wouldn't be surprised to see the stock gap down tomorrow because of the distribution that it experienced. A gap down below the 10-day EMA would not be surprising at all. Also, another thing you want to look at is bearish candlestick patterns. Distribution is not related to the chart pattern. Distribution is just when a stock closes lower than the previous day's close on higher volume than the previous day. It's the opposite of accumulation, which is when a stock closes higher than the previous day on higher volume. That's bullish. And obviously distribution day is bearish. But another thing we look for is actual candlestick patterns. Candlestick patterns where a stock forms, for example, a bearish engulfing candlestick or a reversal bar. For example, a reversal bar is, let me find a good example here. Well, these are strong stocks, so I don't even see any reversal bars. But bearish engulfing, we can see. Again, bearish engulfing is when the stock gaps above the previous day's highs, closes below the previous day's low. And that's what we had, a bearish engulfing on SE today and also on Shop. And also SE had distribution. Notice how it was higher volume than the previous day, combined with a bearish candlestick. There again, another one that I wouldn't be surprised to see gap down below the 10-day MA in this one. And the last secondary signal you can use for exiting is prior lows. What you'll often find is that prior swing lows act as very well as an area of support. Swing low means when a stock is in an uptrend, it forms higher highs and higher lows. And when it goes up to form a higher high and comes back down again, that prior low is known as a swing low. And often what you'll find is those prior lows will actually line up with the averages. And that just kind of gives you some convergence when there's convergence. So for example, notice how the breakout here 2 days ago above the range, if you look at the stock, if the stock goes below that low of that breakout day, that'd be a bearish signal because that's below the prior low, right, from the breakout. But that would also correlate to the stock going below the 10-day MA. On a more significant level, this swing low here is a much more significant swing low. If we break below the 20-day MA, then then we're going to break below that, or we're going to test that level as well. But this is not the best example to show you, but you'll find often where there's charts where the prior lows line up very well with the moving averages. And that tends to be, for example, right now, SHOP. 3 days ago, the prior low of this range, notice how that lines up now with the 20-day EMA. So it's convergence of support there. So apply these techniques that we talked about tonight for an amazingly simple indicator to help you know when to sell, how to manage your winning positions. Use the 10-day EMA or the 20-day EMA, depending on the indicator that your stock is following. Look for a 15 to 20% gain from the time you buy the stock. And once it's up that much, then you start to trail your stop higher. Again, looking for the stock to be up at least 2 times the point value that you're risking initially. So that wraps up what I wanted to review with you. And as promised, I want to leave the session open now for any questions that you have. So if you have any questions, go ahead and type out your questions there in the comments, and we'll answer them in the order received. So any questions, anybody? Okay, it looks like Stacy wants to talk about. Hi, Stacy. How you doing? Thanks for joining us. Okay, Stacy says he has to leave, but wants us to talk about the Amazon position. Okay, no problem. Sure, let's go ahead and take a look at the Amazon chart. Okay, so Amazon. In our newsletter, we bought Amazon over yesterday's high because we had a huge gap up 3 days ago, and then we moved above yesterday's high. That was our buy point on Amazon. Now that's an entry that is a bit aggressive because of the fact that we only had 3 days of consolidation after the gap, but we did buy above yesterday's high, and then it failed on the open. That's not a good sign because we gapped up and sold off all day and closed near the intraday lows. However, we did sell off on lighter volume than the previous day's up day, so that's a good sign. And we're still holding above the previous upper half of the previous day's range, but it wasn't the best price action. It would have been better if it closed above yesterday's high. So right now we're holding Amazon with a stop beneath the gap up day. So whenever you have a big gap like this, that actual gap becomes support. So like if the stock goes back down, looks like 200 is the gap, or 2000 is the gap. So when it goes back down again, it might test the 2000 level or dip below it, but it shouldn't go much below it. So that's why our stop is here, this pink level. That's our stop, because if it goes back below that gap, we don't want to be in it. It'll probably fill the gap completely. But as long as it chops around and oscillates above that level, then that allows the 10-day moving average to rise up and provide support. Even if it just goes sideways for a couple of weeks, that'd be the most constructive price action, sideways for a couple of weeks while the moving average rise up to provide support. The longer that it holds above this gap, the more support that gap provides. So that's how we're going to manage Amazon for now. There's not much about other than keeping the initial stop unless this thing starts to move higher. Does anyone else have any other questions? Any other stocks you would like to look at? Any questions you want to ask about how to know when to sell? Or even if it's not related to that, we have time to answer any other questions as well. Just go ahead and type out your question if you have any other questions there. Okay, I see a question here from Shrikant. Hi, Shrikant. Thanks for your question. Question is, I've been using your process in my trading and it's helped me a lot. Okay, great to hear. Thank you for that. Just curious, hypothetically, how would you manage the Tesla position, given that it was way extended from the 10-day AMA before it fell? Would you use the 5-day AMA? Thank you. Okay, let's take a look at Tesla. You know, see, the thing with Tesla is you have to be careful because when a stock starts to get too parabolic, like if you look here, the stock actually broke out from the 365 level was the breakout, and it went as high as like 900. So basically, you got about almost a 300% rally in the course of only like less than 2 months. So when a stock's rally like several 100% in less than 2 months, you really got to, you really got to be careful because the rally could continue higher, but things can also get very, very volatile. And yes, I actually agree with what you said, Shrikant. You said instead of using a 10-day MA, could you 5-day MA? You definitely can, absolutely. Because the 10-day MA was providing support here. Notice how the 10-day MA perfectly provided support until it gapped up. Now that gap up means the 10-day MA is going to take a while to catch up. So if you were already long Tesla and wanted to just lock in your profits, you could trail an even shorter term moving average like the 5-day MA and look for the first break below that. In fact, you could use a 6-day MA, 7-day MA. It really doesn't matter. What you're looking for is, find the level where the stock seems to be obeying it. Is it the 7-day? Is it the 8-day, the 5-day, 10-day? And wherever it's obeying that level, that becomes your line in the sand. And you wait for a breakdown below that level. And again, with Tesla, you can do just like other stocks. If you're already in this, you can trail a tight stop on part of the position, perhaps using a 5-day MA. And then, if you have a good entry point from a low level, can look to take the profit on the rest when it breaks down below the 10 or the 20-day EMA. DDog, okay. Keith Barber is asking about DDog. Yeah, DDog, we actually wrote about that one in our blog on January 13th, and it's up about 18%, or I think, well, when I last looked, it was 18%. Maybe it's a little bit less now from our entry, and talked about that in our blog post today. So let's take an updated look at DDog. Now, DDog, we actually got in, as I recall, right around the 42 level, around the 15th. I believe it was this day back here, right where this horizontal line is. That's where we bought DDog when it popped above this range. Now, DDog has started to climb higher, but what I don't like so much about DDog right now is it's very volatile. You see these really wide range candlesticks. That tells me that there's a tug of war going on between the bulls and the bears. So we have to be careful with this. We also had some distribution today, a little higher volume than the previous day. However, most importantly, it did hold above the 10-day MA, dipped below it and closed above it. And that 10-day MA, though, notice because the price action, the stock's only started to recently move higher. Notice how we've got crossovers. You see how the 10-day MA and the 20-day MA are crossing over each other here and here and here. That tells us there's not a steady trend. If there's a steady trend, you want to see the 10-day above the 20-day MA, the 20 above the 50, and the 50 above the 200. Like all the moving averages should be pointing in the same direction. So there's not really a really well-established trend. There's a new trend establishing here with the 10-day above the 20, but that's only happened in the past couple of weeks. So I would give the stock more wiggle room in this case because the 10-day MA is not really established too firmly yet as a line in the sand. However, the 20-day EMA now is rising up. Notice how the 20-day EMA, the baseline, corresponds to the prior highs back here from the gap up way back in November. And remember that I said earlier, the prior level of resistance becomes the new support after the resistance is broken. So we've got nice convergence here of the prior highs with the 20-day EMA. So if you're already long DDog, for example, and you wanted to know where to sell this, I wouldn't want to see it break below the 20-day EMA because that would be a breakdown below these two prior lows of these big volatile days and below the prior highs from the breakout here. But that's acting as support as it's supposed to. That's why we had these candlesticks here where we dipped down on an intraday basis and buyers stepped in and bought, closed up here. Same today, dipped in below the 10-day EMA, but buyers stepped in and rallied it back up. So it's still fine, just a bit choppy. But notice how you can see that the 20-day EMA is looking like it's going to be the line in the sand to follow for DDog. QTRX. All right, we'll take a look at that one also. QTRX. Well, this is another case, like I talked about before, just a minute ago, about a stock that's not really in a steady trend. Notice how the stock was in a downtrend through much of last year. It rallied through November, sold off again. Now it's popping back up. So the stock's not really established a firm trend yet. And confirming that is the fact that look at all these moving averages crossing over each other. You see that? The 20 and the 10 crossing over the 50, then the 10, 20 crossing back above the 50. It's just chop city, really. However, it's looking better now than it has in a long time because now we're above these prior highs from back in December. And now we finally have the 10-day moving average trending higher with the 20-day moving average trending higher. But we still have the 50 below the 200. To confirm the uptrend, we want to see that 50 cross above the 200 as well. But it looks like the 10-day MA is starting to act as support. 3 days ago, this stock pulled back and tested the 10-day MA on an intraday basis, but closed right at it. Next day, buyers stepped in and rallied it right back up to the highs of the range. And today, the stock showed great relative strength, closed above the highs of the past 5 days and near the intraday high. So if you were long this stock, you could use the 10-day moving average as a stop with some wiggle room below it. Or you could use the 20-day moving average if you're in from a low enough level. For example, if you bought the this move back here. Irvin, yes, to answer your question, can you watch the video from the beginning later? Yes, you can. We will have this video, should be by tomorrow, on our YouTube feed and also on our Facebook page. So you can definitely watch the whole video, no problem at all, anytime you want to watch it. Okay, and does anybody have any other questions before we wrap up? No other questions? All right. Great. Well, if you do have any other questions, you can always send your questions to Rick or myself. We both get the same email. And that is, I'm going to write out for you in the comments here, editors@morpheustrading.com. This is any questions about our trading strategy. You can just email us, editors@morpheustrading.com, anytime. We're happy to answer any questions you have about our trading strategy. I also want to leave you with this. For those of you who are joining us and are not existing subscribers, this is our company's website, morpheustrading.com. And the newsletter I was talking about earlier is called the Wagner Daily. If you'd like to check it out, you can go to morpheustrading.com and select stock picks and hit this button here, start membership now. And this will get you signed up to receive our nightly swing trading newsletter. In our newsletter, we list our exact entry prices, stop prices, and target prices for all of our trade setups. We give an explanation for why we're getting in it, why we like to trade. So it's educational as well as giving you stock picks. You also learn how to fish. We don't just give you the fish, we teach you how to fish. Every day you'll see, in fact, on our blog last Thursday, we put a sample of our newsletter on there. You could see an actual newsletter. So we'd love to have you join us if you want to find out more about our trading strategy. And of course, we're always welcome to help you. We're always happy to help you through email support. And we even have a live trading room, real-time trading room, where members can access every morning and chat with us and ask questions about our positions and anything you want to ask about. So that's our newsletter. And we've got a YouTube channel as well. Check out our YouTube channel. It's youtube.com/Morpheus Trading. And awesome, great. Lopez, glad you learned a lot. Really appreciate you joining us. DPZ. All right, one last one we'll look at. DPZ here. Okay, DPZ. PPZ. Dominoes. All right, well, if you're long, it's not looking so good, really. Notice how the stock started to consolidate back in December, but it's broken down now. You see the trends reversed. It's now you've got the 50-day moving average above the price, the 20-day moving average above the price, and the 10-day moving average above the price. All three indicators are above the price, which tells us it's in a downtrend now. So it's not something I want to be long. In fact, this is probably a stock you might be able to sell short, except for the rest of the chart doesn't look so good for short. The longer-term chart's just in a range. So I take that back about shorting it. But nevertheless, though, it's not something I want to be long, especially after this candle 3 days ago where we broke major support. If you are long, you might want to use this little bounce to sell into and cut your loss or lock in your profits that you may have. Because as we run into the 10-day and 20-day moving average, this is going to act as resistance. Just as it acted as support below, it's going to act as resistance on the bounce back up. Okay, great. Well, that wraps everything up. That concludes our boot camp session. Be sure to join us at our next boot camp. Depending on the response we get, if you guys like this, let us know. That encourages us to do more of them. We love sharing our knowledge with trading for people that are serious and want to learn. And we'd love to do more of these boot camp webinars with different topics each time. And so if you have a particular request for a topic you'd like to see covered in a future webinar for future Morpheus boot camp, let us know. We'd love to hear from you. Otherwise, thanks for joining us. And you can check out this video as soon as we post it on our YouTube channel and our Facebook page. Have a good night, everybody. Thanks.